Thank you so much for having me here with you today. I look forward to receiving your comments. This is a joint work with Svetlana Brizgalova, Mayuk Mukhopadhyay, and Varun Sharma. And so first, let's think about sentiment in the business cycle. What drives the business cycle? And so there are I think, two approaches that the classical economic literature has highlighted. The first, so two shocks to fundamentals or potentially sentiment. And so the question is, how important are these forces in driving the business cycle? Now, what we're going to do in this paper is we're going to essentially create our own survey, if you will, of these expectations, but we are going to use newspaper data, right? So I think there's not a lot of disagreement that expectations and sentiment are crucial over the business cycle, regardless of whether you take the rational expectations view or whether you take the irrational sentiment part view. But in any case, we think it's important to try to identify this. Now, identifying shocks to sentiments has been done using structural models, and it has been done using survey-based measures, such as consumer confidence. But the existing surveys that we have are rather short-lived and target few economic objects. Another thing about, it's not just about the time series that is rather short-lived, it is also that we don't have very high granularity in terms of these measures. So the question that we want to answer in this paper is, can we measure sentiment for a longer period and at a more granular level? And so we can use unstructured texts such as newspapers because those are available for a much longer period of time. And so this is how we get to almost 200 years of economic sentiment data. And so local newspapers on top of that are available in many states. And so these local newspapers allow us to focus in more on the news reporting and the sentiment incorporated in that news reporting in those local areas. That, of course, doesn't mean that it's possible that national news still enters in those local newspapers. But as you can imagine, we can just take the national aggregate and try to control for that and see which variation in sentiment is left in these local areas. And so I'm going to show you later that only about 30% of the variation in the newspaper sentiment is related to the aggregate. The rest seem to be variation that seems particular to the local newspapers that we're talking about, right? So how do we synthesize relevant information from a diverse pool of topics covered by local newspapers? And so we're going to use advanced machine learning techniques to try to elicit that information from these newspapers. Now, how much progress are we going to be making on is it rational versus is it irrational? So so one big caveat that I need to give is we are simply going to define sentiment more in the general meaning of the word, meaning how positive or how negative about particular topics and particularly economic topics is the newspaper. And so that's why we call that sentiment. We will not be able to perfectly separate which part comes from an expectational component versus an irrational component. But what I am going to show you, and I think that that does give us quite a bit of information, is what the differential predictability is that comes from these sentiment measures. So if you think about a rational expectations model where analysts that forecast particular economic quantities have rational expectations, then it shouldn't be the case that the sentiment indices that we are going to be constructing have additional predictive power over and above the forecasts that they give. And I'm going to show you that that this sentiment thing that we are uncovering does have differential incremental predictive power over a number of baseline specifications that we're going to look at. So the data that we're going to use is one of the biggest bodies of local newspaper articles in the world. It has 193 million pages, approximately 2 billion newspaper articles. And so we are going to be using state-of-the-art and a versatile methodology to extract these views and attitudes about a particular topic. And so one of my co-authors here has been working on that way of extracting these views. And so we're going to use word vectors based on neural networks that I think has been applied by several other people. At this point, there may be the question of, well, obviously the machine learning techniques are constantly evolving, and couldn't you use and the next iteration and the next iteration and so forth? One constraint, as you can see, is that the amount of information that we are feeding the algorithm is really, really large. And so the cost of using the most advanced machine learning techniques on this size of the data set would be prohibitively large and therefore not feasible for us. And so therefore, we're going to apply the framework that we're going to apply here today. Right, so what is the measure? We're going to construct a news-based economic sentiment measure at the state and country level for about 170 years. And we are going to separate overall sentiment from the economic sentiment. Or another way of saying it is, we are going to take a look at the sentiment that is in all newspaper articles and compare that to the information that is in the economic related newspaper pages. And then we can orthogonalize the two with respect to each other to construct an orthogonalized economic sentiment measure. Now, as I said earlier, is this about irrational exuberance of cash flows versus just discount rate news or something else? And so the question is, what exactly does our measure pick up? And we will empirically explore to figure out what that is. But we are simply going to look at the positivity, the relative positivity or negativity of economic news coverage across these different areas. So what are the findings? So first, sentiment has a very clear business cycle pattern. Two, we just also see whether what we're picking up is a sensible measure. We are going to compare our economic-based measure with, say, the Michigan survey, which of course exists for a much shorter period of time as our measure. And we're going to find that while there are some deviations, broadly speaking, our sentiment measure seems to follow the Michigan survey. I'll show you a picture that compares the two. Interestingly, at the very end of the sample, they seem to diverge a bit. And so we can think about where that divergence comes from. We're going to find that our country level measure leads the survey of professional forecasters, meaning that our sentiment predicts their forecast, which of course in turn predicts GDP. And so therefore our measure has differential predictive power, incremental predictive power for GDP growth. We're also going to think about, if you decompose GDP in its labor and capital inputs, through which of the two channels the sentiment seems to operate most. And even though we thought that through the investment channel, that would be the most logical one for it to take place, we're actually finding the other thing, which is that it's through employment and hiring that the sentiment seems to have the biggest influence, not through the capital channel. Right? So we also find predictive power for employment and also for consumption and services, controlling for past fundamentals. And then finally, we are going to take a look at a version of the Taylor rule and see whether the sentiment measure predicts changes in the Fed funds rate relative to the most recent empirical specifications of such a rule. And we are finding that it does actually seem to predict monetary policy, particularly during recessions. So it seems that monetary policy decisions are affected by this sentiment measure over and above what empirical specifications of the Taylor rule would predict. Now, next, we're going to look at state level information, right? So you can essentially choose for our measure at what level of granularity you would like to do it. So in this paper, we do an aggregate version for the country, and we're going to do a state level version. And so we find that the sentiment also seems to work at the local level. So if you think about GDP growth at the state level, we can see that there is predictive power controlling for both state and countrywide fundamentals and the national level of sentiment. So that means that the local sentiment has additional predictive power over and above those other control variables. As I said earlier, the common trend across all states is only about a third of the variation that we're seeing at the state level, so leaving room for a lot of cross-sectional idiosyncratic variation across the states. Higher dispersion across states on top predicts lower GDP growth. So when, say, the difference between New York and California in terms of their economic sentiment is very large, and so if they start diverging, that is not a good sign for future GDP growth.
Jules?
Yes.
Yeah, we have a question from Fred Jawadi. Fred?
Yeah. I have two small questions regarding the methodology that's used to compute your sentiment. So the first one is about
would you mind holding off on that until I've covered the methodology?
Yeah.
Yeah, because I haven't talked about the methodology yet.
Just one point very quickly, whether you make a difference between the attention and the sentiment.
So, sorry, say that again.
Investor attention, does the sentiment capture the attention?
Attention.
Yeah.
And you mean attention for what?
Yeah, I mean that the topic that you use to compute the sentiment, does it capture the attention of investor? I'm interested in something, so I'm going to feel either positive or negative about that. So this could be analyzed in the paper that you use. So, and I don't know whether your methodology does enable to make the difference between investor attention and investor sentiment.
Well, so first of all, we are mainly finding predictive power for fundamentals, right? So we're talking about GDP growth and employment growth and consumption growth. And so we are actually not so much finding predictive power, say, for stock returns going forward. And so I don't think this is a story about attention for, say, particular financial instruments or stocks that then would change their price. So I haven't said anything yet about predicting financials or security prices, right? We're mainly talking about predicting fundamentals and potentially monetary policy decisions, right? So that's a little different than the attention of investors for something. This is about the decisions. Also, the fact that it predicts consumption and services is about the decisions of agents, real agents in the economy, not the investors.
Okay, thank you.
Yep. All right, so we are going to be measuring sentiment from text. We're going to study then first the national news-based economic sentiment measure and its properties. Then we're going to think about what it predicts and whether it has additional predictive power over and above other things. And then we're going to think about the potential channels through which that predictability can happen. So, and I think that refers back to the question I just asked, which is, well, is this something that goes through the capital channel versus, say, the labor channel? If it goes through the capital channel, maybe there is something about securities prices or the price of financial securities, say stocks or bonds. What we're mainly going to find is that it operates through the labor channel, not through the capital channel. And then finally, we're going to find local variation in economic sentiment. And then we also find that the predictability results also happen at the granular level, not just at the aggregate level. So, as I said, historical collection of digitized newspapers over a very long period of time, 13,000 local newspapers across thousands of communities, 193 million newspaper pages, 2 billion newspaper articles. And now the corpus that we're going to look at is 95 times larger than all of the English language Wikipedia corpus. So just to give you a sense of how much information we're talking about here. Now, one thing that is, of course, important is that the amount of information that we're getting here is increasing a lot over the sample period. And so therefore, we need to be careful, particularly also when we're going to look at cross-sectional variation. I'll show you some pictures of this, that over the sample that we're using, we have enough newspaper coverage across the different states to do this cross-sectional analysis. We're going to use long-term GDP data from the Madison project. So here you see that the data set covers 47 states for at least 100 years out of 170. So here you see the median number of newspapers per year that you have in these different states. And so you see that there are some local newspaper coverages that are on the lower side, which you see in red, and you see others where we have a very large number of local newspapers that are reporting in these particular states. So how are we going to measure sentiment? So what's the roadmap? So generally, and we're not going to be doing that many different things than choices that other people have made. So the first step is create a dictionary of relevant words for the topic, then identify the words that are positive or negative, and then apply this dictionary to measure the intensity of positive and negative sentiment in a particular document. And the way how the method works is that there's going to be a vector representation of each word, so that you use how close a particular word is in that vector space to another word that is related to it. So in particular, we're going to use word2vec based on neural networks. It actually applies both to phrases as well as words, and it seemed to work quite well. Now, of course, as I said earlier, if we would apply the most recent machine learning techniques, say ChatGPT, would that change things? And I think that there should be an ongoing agenda where we try to do the best we can. At this point, it's not feasible for us to use those techniques yet on the large data set that we have. And so we use, as I said earlier, we use the distances between the vector representation of the words to measure their similarities. And so, for example, you see here in the vector representation, if you take king plus woman minus man, then that is approximately equal to the word queen. Now, here's a word cloud of words related to the word economy. And so you see here, I think, all kinds of words that relate to it, right? All these words are in some way economically related. So lots of statements about inflation, but also statements about, say, that all the way on the left in the middle, you see there Chairman Alan Greenspan is mentioned. You see crisis, you see recovery, you see slum, you see trade deficits, stimulus, deflation, job creation. So all sorts of words that clearly are related to the word economy. And you see down there the closest associations that we find in the database. Now, we need to start with a few seed words related to sentiment. And so you see here the list of positive words that we feed the algorithm and a bunch of negative words. Now, of course, due to the similarity in the word vectors, it's going to figure out on its own which other words this can be built on, right? And so it's not that it's restricted to this. It's exactly that the algorithm is going to use close associations with these words to measure positivity and negativity. And so the gold standard to generate sentiment scores for economics and finance is the Hamilton 2016 work. And so we're going to produce a continuous measure of sentiment for each word or phrase in the dictionary. Now here you see a list of the most positive words, right? And you see also a polarity score. So that we're going to rank all words on this polarity scale. And we have here the number of positive words that are being extracted, as well as the negative words that are being extracted. And so again, if you look over these words, then you see, I think, most of the words that we as economists would relate to positive and negative economic news. So then next, we need to aggregate sentiment, the sentiment score of a document. So we're going to produce a vector representation of the document. And then one thing that we're going to do to try to separate economic news from non-economic news is that these newspapers have dedicated economics pages and general pages. And so by comparing the polarity score on positivity and negativity of the economics pages versus the regular pages, we can try to separate overall sentiment from economy-wide sentiment. And so the question is, how much of the trends that we're going to see come from these places? And one of the key results that I'll show you in a little bit is that there is a very important trend in the overall negativity that that news reporting seems to exhibit. And so the question then is that something that is, say, due to secular stagnation in developed economies and an economic phenomenon, or is the negativity also driven potentially by just overall negativity in the news? and we're going to find evidence for the latter. And then we can speculate a bit about why is it that news reporting, or particularly over the last 50 years or so, has become more and more negative every single time. The time trend is going to imply that news reporting today is as negative as it's ever been over the 170-year history and that we are studying. And there are lots of theories about this, and we discussed these different theories in the paper, although it's not the purpose of our paper to nail one of the reasons why overall news reporting has become more negative. But we do want to point out that this negative trend is something for other researchers to pay attention to and to dig further into to figure out what is driving this. One explanation could be the competitive pressure in the newspaper business and the fact that bad news sells. Under increased competitive pressure, you would then expect to see the trend that we see. Although then, of course, you need to come up with a theory for why the competition is exhibiting the trend that we're seeing. But that is certainly one of the potential explanations. Okay, so then we're going to, once we have these aggregated vectors, we're going to measure the similarity between the vector representation of each newspaper page and our economic dictionary. And then we're going to aggregate to whatever level of aggregation you want, city, county, state, or country level. As I already indicated in the beginning, our empirical analysis is mainly focused on comparing country level and state level. Our paper currently doesn't have many results related to county and city level. And then we can seasonally adjust the final measure. So what are the, sorry, yes.
Yeah, I just have one question. Why do you seasonally adjust the data? I mean, what is the meaning of seasonality of this? Because there is a meaning of seasonality in terms of sentiment, maybe when they publish their annual report or stuff like that, or quarterly report. I don't know, but it's not standard in the text mining literature to seasonally adjust the results of the sentiment analysis. You can seasonally adjust the economic data, but less the sentiment measures.
Well, so the question is, if we seasonally adjust the Y variable, should we also seasonally adjust the X variable? But I think it's perfectly fine to just do one and not the other and see what difference that makes. I'll put that on the list.
Okay. Thank you.
So what are the key advantages? Well, almost fully automated construction of topic-specific dictionaries. And so it can easily be applied to any other context or topic. So there's obviously no need to manually create the whole dictionary. It also really helps that it reflects the context in which the words or phrases are used, right? So, for example, if you think about the word soft, that can mean many different things. If it's about a plush animal, then soft is generally used as a positive word. If you say about some athlete that they're being soft, that's generally not a positive word to use in that context. And so understanding the meaning of the words in their context is important. And so it automatically deals with negation, a common challenge, which is a common challenge for word counts. And so we need to make sure that good versus not good is properly taken into account. We cannot just count the occurrence of the word good and then say that that's a positive index. We need to make sure that if there's any negation around it, it's counted as the negative. And then we also want to have a continuous measure. So we don't just want to count good and excellent as a +1 for each. There needs to be, and again, this polarity score and the vector representation of these words is really going to help to continuously assess what the difference between excellent and good is. Right? And then finally, it's not just the keywords, obviously, that we're capturing, but there's synonyms and related language that talks around the particular keywords is also taken into account. All right, so first, let's look at some results. So here you see a quarterly measure of raw economic sentiment between 1850 and 2020. And so I think that there are a whole bunch of interesting data points in there. The gray shaded areas are the recession periods. I want you to particularly look at a couple things. The first one is look at the 1929, the Great Crash, and then the Great Depression after, and what those years have done. So you can see this very steep drop to, which is really the lowest point up until that point in time. But then also see that the news reporting during the Second World War period actually improved a lot and became very positive. Now, again, there are a bunch of different theories for why that could happen. It could be that economic sentiment was just improving because of the investment in the weapons industry and the positive economic consequences that had. That's one. Another one is that maybe general reporting was more positive during the war period just to get everybody on board. Although, of course, that is supposed to be captured by the overall sentiment measure that we've orthogonalized, though over the whole sample with respect to that measure. The other thing that I think is important is to see that you see there that the drops at the end seem to be particularly strong with each consecutive crisis. So if you look, say, at the popping of the internet bubble, we see this huge drop in sentiment over, but then there's no real recovery after that. And then the 2009 crisis happens, and then you see another drop, and again you don't see really much recovery after that. And then COVID happens, and then we end up with this very low point. So notice that this is markedly different from this war period, where the Great Depression led to this huge drop, but then there was also the large mean reversion and even an increase to a point that is the highest point over the whole sample. And we're not seeing that anymore in these later samples. And finally, as I said earlier, the sample ends at the lowest point of the entire 150-year period.
One quick question, Jules.
Yeah.
So here the index is shown at the quarterly frequency. What's the higher, from the highest frequency that's relevant, that's meaningful, that you can derive from your exercise? You can get a daily index.
Yeah, I think it's possible, and in principle we could look at that. The reason why we haven't much so far is that for most of the sample, as you can imagine, particularly, let's say it this way, early in the sample we don't even have good quarterly data. We only have annual data, and then when it comes to measuring, say, GDP, and then after some point in the 20th century, we're going to get quarterly data. And then only very recently, I think, people are starting to look at higher frequency alternatives. And so it is definitely possible to construct a daily index. And although we need to look a little bit at what the exact frequency is of which newspapers are published when, right? And how frequently per week they publish, but that is totally possible. The question is, what is for the historical context, and this is really a paper that focuses on this long history, how useful will it be that we have daily data in 1899, right?
And when you try to predict stock returns, you did that with what, a quarterly economic sentiment?
Yeah, we do that with the quarterly, and maybe you're saying if you had real-time data, maybe you could do better.
Okay, thanks.
Yeah, so we can certainly look into that.
Jules, we have also a question from Fred Jawadi.
Yeah, thank you. If we look at the data between 2000 and 2009, and we can observe that the sentiment has been always negative all the time. Or we know all that after 2000, there was a recovery for the financial market. And between 2000 and 2007, the financial performance was high and the recovery was doing well. And one could expect that the sentiment could be positive during this period before the correction in 2007. But if we look at the data, the fact that it was almost negative, does it mean that a negative sentiment dominates the market during this period?
Well, so a couple things. So I have another paper which is called Duration-Based Valuation of Stocks, where I look at the returns and volatility of the stock market relative to a duration-based bond equivalent, meaning say that we should not be comparing the performance of the stock market to say the 1-month T-bill or the 1-year T-bond, but rather what we should be doing is we should be comparing it to a duration matched cash flow pattern, which is much closer to, say, a 30-year bond. If you look at US stock market performance relative to this long duration bond counterfactual, then because of the decline in interest rates over this period in time, actually the stock market didn't do so well at all. And so the performance of the stock market hasn't really outperformed that of the bonds over a 50-year period between 1970 and 2020. And so I think that's important in the context of the question that you just asked. Because in the end, the question then becomes, why is the valuation of the stock market as high as it is? And there are two reasons. One is strong fundamentals and strong growth outlook. The other one is cheap money and low interest rates. And it does seem to be the case that over that sample period, it's really the low interest rates that seems to be largely responsible for the high valuations that we're seeing, not the strong fundamentals. And this sentiment is really, as we're going to see, the predictive power is related to GDP growth and other things. And so I think this potentially could relate more to, say, the secular decline in growth expectations between the 70s and the 2020s, right?
Okay, thank you.
Jules, I have one question for me. So, don't you think that there is a kind of behavior, you are measuring the behavior of journalists, that they were maybe more objective or more positive before the 60s, and then after they are more negative?
Yes, and so this is the reason. So that's a good lead into this one here, right? And so the blue line is just what general sentiment looks like, right? So you see here that since the 70s, you see that news reporting in general has just become more and more negative, exactly as you suggested. And as I pointed out earlier, that if competitive pressure for the news business increase, then maybe the rational response from a business perspective for a journalist is that if you know that bad news sells, you report bad news. And so therefore, in the predictive regressions that we're going to be running, I'm going to be using the orthogonalized version of the red line with respect to the blue line, right? So in other words, I'm going to just take out this overall trend, and then you get more something that looks like this, right? So it still means that even from an economic point of view, we are currently in quite a low period of time, particularly in the last decade on average, compared to the mean that we see for the full sample, right? But it's not as dramatic in terms of this downward trend. You do again see that the World War II seems to be at a high point, right? So I think that's important. And again, it seems that the Great Depression is on a lower point.
Jules, do you have external evidence of this secular trend, the one you showed on the previous slide with regards to the downward trend of overall sentiment? Because otherwise, it could also be due to some decay in the algorithm or concept drift in the data. It seems to be hard to rule that out, no?
What do you mean with drift in the data?
I don't have anything specific in mind, but it could be due to some bias in the algorithm rather than an actual downward trend in the overall sentiment.
The only thing that we're using is the overall positivity or negativity of the reporting. That's it. We're not doing anything else. All right, so it's just a matter of the frequency of positive and negative words and in their context as they're being used. And so I think this and one thing that could be possible is that different words were used at different times, but we also looked into that, and that doesn't really seem to be the explanation. And so I think that the statement that newspapers today are just more negative than they were before, I think it's hard to ascribe that purely to the algorithm, given the fact that the algorithm just measures positive and negative words. That's it. Right? So now we can quibble a little bit about the definition of negativity, perhaps. Maybe that's then something we can do. But I think it's going to be tough to. The other thing, a couple other comments on this. We're going to be finding this same result across the different states. So even if we cut up the data in the 50 different states, we're going to find this downward trend for all 50 states. right? So it has to then be an explanation of something that happens that is not shared. Given that it's shared between the 50 states, it cannot be that idiosyncratic variation or related to that variation. It has to be something else. But I'm sympathetic to your question. I just without a specific sort of concern, it's hard for me to address it.
Great, thanks.
So now here you see what our sentiment measure picks up in red, and then it compares that to the consumer sentiment measure of the Michigan survey, right? And so you can see that the correlation is 71%, so it seems to be picking up quite similar movements, not just at the low frequency, but also at the higher frequency. If you look carefully, you see a lot of coincidences there. You do see a little bit of this deviation towards the end of the sample, right? And so again, it's interesting to explore what could cause those differences, because for the rest, they seem to follow each other quite closely, and we do see that that towards the end they start to diverge a bit. All right, so then next, let's think about whether or not we can predict log changes in GDP with respect to lagged sentiment measures. And then you can see that even if we control for what many people use as recession forecasters, things like past GDP growth as well as the term spread, we see that our sentiment measure has substantial additional predictive power over and above those standard measures that people use. And the coefficient estimates, so you can think of the sentiment measure as measured in standard deviations, and think of the quantity of the coefficient as percent. You can see that there is a meaningful variation by which sentiment, a standard deviation increase in sentiment, translate into forecasted GDP growth. Right, so there's also some room for lags under certain specifications. And so some of them are significant, although if you go far enough back to the fifth lag, say, there is not much left. Oh, sorry, got stuck for a second there. All right, so this is quarterly data. We can do the same thing here over annual data. And then the different specifications also really look at a whole bunch of different subsample periods. Obviously, we lose a bit of power if we go to the subsamples because we have less data and therefore statistical significance could be affected. But I also I think it's important to notice that the coefficient estimate remains actually quite strong all throughout, and depending on what subsample we pick, we have good statistical significance there as well. And one more thing, which is that it might be worth it to think a little bit and place the results in the context of the variance that the y variable has to begin with, right? So obviously a coefficient of 1 towards the end of the sample, if which is specification 6, right, the one all the way on the right, and given the fact that particularly in the US, the depths of business cycles and the amplitudes of business cycles is reduced, in the context of the variable you're trying to explain, that coefficient is still very large. So I think that's important to keep in mind. All right, so then our measure seems to lead the GDP forecasts, right? So we're going to be using the GDP forecasts between t and t+1 and see whether the lagged sentiment measure. So it's the forecast made at time t, right? That's the way to think about it. The forecast made at time t for t+1 compared to controlling for the forecast made at time t-1 and the sentiment measure at time t-1. And so, as you can see, our sentiment measure once again has substantial predictive power for what they are forecasting. So therefore, our sentiment measure seems to be leading the consensus forecasts of the analysts. And so our measure still leads GDP growth even after controlling for the consensus forecast. So we have predictive power from our sentiment measure, even if we take the forecasts into account. And so for some reason, the professional forecasters are missing out on the information that is incorporated in this consensus, in this sentiment measure. Now, another thing that we can do is we can separate the economic news that we have through the text algorithms into text that relates to current forecasting, as well as statements that relate to the future. And so what we're finding is that the forecasting power for GDP growth seems to come mainly through statements that relate to the future rather than to statements that relate to now. And so again, that's, I think, is a good sign that that sentiment statements regarding the future are causing or are leading to the predictive power, right? As you saw, I took back the word causing. I'm very careful in this paper to claim causality anywhere because of the reasons that I indicated at the beginning, right? So the only thing that we can do right now is just evaluate predictive power and to document the correlations that it has with sentiment. To definitively say what causes what, I think is a tough call to make. All right, so now if we want to think about forecastability, the question is where does the GDP forecastability come from the labor or the capital channel? And I already gave you the overview of what we're going to do here and what we're going to find here. And the answer is that if we think about investment and industrial production, there doesn't seem to be much going on. Whereas if we go to employment and the consumption channel, then it does seem to have predictive power there, right? So particularly in that first panel on the left, it does seem to be the case that sentiment has very high predictive power and strong predictive power for employment growth, not so much for investment growth. Let me skip this because I'm running out of time. So then let's finally think a little bit about the Romer and Romer specification of the Taylor rule. And so the question then is, over and above that specification of the Taylor rule, does sentiment seem to have some predictive power? And the answer is yes, there is some predictive power, but it seems to particularly hold in the downsides, in the recessions, right? And so it's roughly equivalent to, say, one cut extra in the federal funds rate if you have a one standard deviation decrease in sentiment over the past 2 quarters. That does seem to have predictive power for predicting one extra rate cut. And so that is also a non-trivial result, I think, that over and above these standard specifications of the Taylor rule, sentiment seems to have predictive power for Fed policy. We do a whole bunch of different specifications. So R&R stands for Romer and Romer minus unemployment. So we take out separate pieces. So UNAMP is unemployment, GDP, and inflation. All right. So finally, a couple things. So here you see
Jules?
just a couple of yes.
Yes, we have a question from Prej Awadi.
Yeah, one more question, please, about the Taylor rule. Does it mean that the central bank should target the sentiment in its reaction function?
Well, I think that the better statement is the sentiment seems to be in the function. And so I think that this should lead to a debate on whether you want that yes or no, right? So now there is a bit of the question of, well, it does seem to predict, the sentiment seems to predict GDP too. And so then we have to think a little bit about the mandate of the central bank, right? But the first thing to establish is whether or not it's intended or not, whatever information is in this sentiment index seems to be in the response function. And so I think a first question to ask is that desirable, yes or no? And was that intended, yes or no? That's the first question. And then the second question is, how does that then interact with the predictability that sentiment seems to have for GDP growth, right? So that's the second question. So I cannot make the statement, like, sometimes what people do is they look at what central banks did and then they compare it to some Taylor rule, and then they use the Taylor rule as a normative way of evaluating whether the central bank has been too aggressive, yes or no. So that is one approach that people take. Here, I'm just reporting that the sentiment seems to enter into and is able to predict the rate cuts. And so maybe this is more a question for you. Do you think that as a central banker, do you think that it deserves to be in that rule, yes or no? Right, and so maybe we can have that discussion later. All right, so so here you see the sentiment for 3 different states, just to give you an illustration. So a couple things. You see that the local sentiment measure again seems to have this trend down, right? So the trend down is shared across different states. But the other thing that I think is important is that there is a huge amount of cross-sectional variation, right? So and we have a couple of pictures, right, where you can look at the .com bubble, right, when that burst. Who was mainly affected by this in terms of the sentiment? And obviously you see that California is red while New York is green. Whereas if you look at the global financial crisis, which the real estate crisis, the Great Recession that we saw, we see quite the opposite. We see that New York is red and California is green. And so different events that are happening affect the sentiment in states quite differently. And perhaps that's not all that surprising, but figuring out which fraction of the variation is coming from the national trend versus how much room there is for local variation is an important empirical question. And the answer is the majority of sentiment variation is local, not national. It's only about 1/3 that's national, right? So then, so the last couple things we want to explore is, well, what about predicting local GDP with local sentiment? And then you can see that again, there is this strong predictability of lagged sentiment on GDP growth. Right? And then finally, we do not find that much predictability for inflation, right? That was something that I hadn't addressed yet. So it seems to be mainly real economic activity through the labor channel. So again, relating it to central banks, I'm not sure how much sentiment really has to do with the inflation part of it. It seems to be more related to the unemployment part of the mandate. And then the last thing is, what does dispersion in sentiment do? And it seems to be the case that there's a negative relation between the dispersion in sentiment and aggregate GDP growth. So large dispersion in economic sentiment across the areas does not seem to predict. It seems to predict lower national GDP growth going forward. All right. So let me conclude. So I think that we just did a very sort of pragmatic approach to measuring the tone of newspaper articles, which most people in common language English would call sentiment. But we're also fully aware of the fact that the word sentiment in the economics literature is a much more loaded, if you will, term, because it's generally used in the context of behavioral sort of effects. So there's still room in our framework to measure that too, but it's also possible that it could be a self-fulfilling prophecy even, or rational sentiment. All of these variations and gradations are all possible. And so the first thing we just did was document what the sentiment in these newspapers looked like for 150 years and seeing what forecasting power the sentiment has. And I do think that that raises a whole bunch of additional questions that people can dive into and try to tease out these different effects and what causes what exactly. We don't have a clean instrument or a shock to sentiment that is completely unrelated to everything else, right? So I think it's important to try to think on whether that's possible at all. And I think that that would be interesting as an extension. Thank you.
We have also a question from Victor Marinkov. Would you like to ask it?
Yep. Hi, Jules. Can you hear me?
Yeah.
Oh, great. So great work, by the way, very insightful. I saw what you showed in the beginning about the Michigan Consumer Survey and how similar they were, but I couldn't quite understand. So similar relationship with the other variables, like you showed with your sentiment index, and bottom line.
What do you mean exactly in terms of predicting the outcome variables, or in terms of? Yeah. So one downside of the Michigan survey is that it's available over. So I only showed you the plot over which the two overlap.
Right. Exactly.
Right. So a lot of the purpose of our exercise is to try to get this long historical sample, and to see what the long-term relationships are. I think there is a literature that uses the Michigan survey and tries to do some predictability with that. And there's a larger literature that tries to see whether consumer sentiment can predict things. And I do think that they find somewhat different results in certain places. So, for example, the question of whether inflation is predictable, yes or no, or whether it's through the investment or the labor channel. I think that, and we summarize this in the paper, so you can find some more background information there. But we find somewhat different results than the existing literature in terms of which parts are predictable. But I think the biggest advantage of our approach is the long sample and the granularity, meaning that we can run everything at the state level, and we can run it for 150 years. And so that, of course, is part of the reason why we may be finding somewhat different results than others, because we have more data in both dimensions.
Sure. Yeah, that makes sense. I suppose you could rerun some of the exercises, especially in the later years when they overlap, and just say, look, perhaps we add something more that they don't, or controlling for the Michigan survey sentiment, we find a significant effect. I think that would just make your case even stronger.
Yeah, I think that's true. Although I also think, and I think that comes back to Jonathan's question earlier, or I think it was Jonathan who asked that question. In principle, what we are measuring is not consumer sentiment. Right, we are not going with surveys to people and ask them specific economic questions. We are going into unstructured text sources that report on a whole bunch of different things, and we are trying to elicit the overall tone of that information and see what it relates to. So in that sense, it wasn't. I mean, we happen to find that it happens to correlate over certain parts of the sample with the Michigan survey, but it wasn't a foregone conclusion that it would, right? And in the end, the correlation is only 0.7, right? So that's not perfectly correlated. We do feel, and so there I'm on the same page as you, that it lends credibility to our measure, that it co-moves with other somewhat related variables, but we are measuring something different. So to the extent, for example, that our measure is influenced by the lens through which journalists view things, that would not be the case for the Michigan survey, and it would be true for us.
Yeah.
Right. But I'm sympathetic to your question. Purely from a forecasting exercise, if you do a horse race, what predicts better? But once I do just the horse race part, I'm not sure I have to restrict myself to the Michigan survey only. Then I think we should use all kinds of other variables too, and we did already some of those, but you see the difference, right?
No, I get your point. Yeah. All right. Cheers. Thanks. Yeah. Thank you.
Yeah. Thank you very much, Victor. So we have another question from Fred Jawadi.
I think you're muted, Fred.
Can you hear me?
Yeah.
Yeah, I have two small questions. The first one is whether you try to see if the sentiment is a good forecaster during calm times or during economic recession. Given that, is it more helpful when the economy does cross an economic recession, or it does a good job to forecast whatever the period? This is my first question. And my second question, whether you try to see if there is a kind of interaction between the macroeconomic variable and the sentiment. That means you put them in the system to see whether there are some lead lag effects between the sentiment and the economic variable.
Yeah, so Jonathan, so there was a little bit of noise on my side of the line. Would you mind repeating the question?
Yeah. Please repeat, because it's not my fault. Someone switch on his microphone. Sorry.
Okay. So
Fred, if you can you ask the questions again?
Oh, just my question is that if the sentiment is a good forecaster during crisis times, or it does the same job, whatever the phase of the business cycle.
Oh yes. So first, so we very clearly find that for the monetary policy, the downside, the recession part, is stronger than the upside, right? Yeah. So certainly there, the asymmetry is definitely there. I think we also ran the recessions and expansions separately for the GDP growth forecastability, but I have to revisit that, and I'm not sure I'm not sure there was that much of an asymmetry compared to the asymmetry that we're finding for the Fed funds rate, but it's certainly something that I can look back into. And then the second question was what?
Yeah, my second question, whether the macroeconomic variables could help to forecast the sentiment.
Yeah, I know. So that's a great question. And it's something that we have thought about too, right? So you can think sort of about a Granger causality framework, where you can say how at various lags do each of the variables interact with each other, right? And so obviously there has to be something or some shocks or something that happens that drives the sentiment too. Although, as we saw, lots of the shocks that caused the downward trend seem to perhaps be related to other things. But even there, I think it's interesting to see, are there particular shocks to competitiveness or other things that are happening in the journalism business that could help explain the sort of downward increments in the trend there? And so trying to explain what variables forecast sentiment, I think, is yet a whole other paper that in principle we could write and think about, because it's an important question. But we have not done that much on that front yet. We mainly at this point were interested in seeing how sentiment had incremental power for the other things. And so my prediction would be, given the fact that we are seeing that sentiment takes these big hits during the recession periods, that sentiment is driven by economic events as well that happen to people in their lives, and that leads them to lower their economic sentiment value. So I think that past shocks to the economy certainly will affect sentiment too, right? But remember that when I'm doing my forecasting, I'm already controlling for lagged variables of these other economic fundamentals, right? So I'm already controlling for lagged GDP growth, and I'm controlling for a bunch of lags of several, the yield spread and other things. We've looked into all of that, and adding more lags doesn't seem to make the result go away. So it somehow needs to be shocks to economic quantities that are not the usual suspects. It has to be something else. But that doesn't mean that we won't be able to find certain variables that seem to particularly affect the mood. And particularly from a political point of view, if you're worried about the mood and you want to prevent the mood from turning too bad, maybe understanding what drives the sentiment is a whole research agenda in and of itself. I think that that's important too, because even, and I think that comes back to Jonathan's question from earlier too, even if the journalists are doing this because of competitive pressure or because of their business is changing, I mean, it is certainly possible that still affects how people view the world, right? Because if you constantly read all this negativity, can you de-bias that yourself as a consumer of that news, or will it affect you anyway? And so I'm completely on board that this is the next step that we should look into and try to find out, both for general news as well as economic news in particular.
Thank you. Thank you so much.
Yeah, of course.
Thank you very much. We have another question from Yuval Hirschholm.
Yes, hi, thank you very much. It was very interesting. I would like to ask 2 quick clarification questions to The first is about splitting the articles, the economic ones from the general newspapers. If I understand correctly, you just use the pages on each issue where the article was mentioned, right?
Correct. We do not do it article by article. We do it page by page. So that is not a perfect split, but it's very highly correlated with it, right? So we colloquially say the economics pages of the newspaper, right? That's how we colloquially say it. And now of course, and just as one quick point of clarification, and that I do think is important also for the future, is that our study is really done on the traditional sector where you got newspapers in paper printed form that you send to people, right? At this point, there are very few people that consume the news that way, right? So at this point, you get recommendations from on your app. And so sort of the way that you consume newspapers today is different than it was before. And secondly, overall newspaper consumption has gone down quite a bit, particularly in the last couple of years. So if you wanted to do this study going forward, what would you call economic news? How would you classify it? And what other sources would you like to include? Right, you could include social media as a source of information, although I think many of us would be very hesitant to do that.
No, I get it. So the other question was, you cannot really further split your sample of news articles, right? Meaning different types of economic news regarding the financial markets, perhaps, or unemployment, different kind of stories. You cannot really differentiate between the stories, right? Because it's all.
I think we could, particularly so. It all depends on the seed words and that you use to identify whatever topic you want. So if you said, I don't want to have general economic news, I only want to focus on news that relates to the stock market, you can obviously construct word vectors that with seed words that particularly relate to stock market type of language, and then take articles that are the closest in the vector representation to that particular subtopic. So I don't think in principle there's any limit to how specific you can do the analysis. It is, running each of the analyses is very costly. So it's not like we can just take 30 topics and just throw it at it and that would be easy. But if there's something particular that you're looking for, I noticed a lot that people here are interested in, say, daily data that can help you forecast stock returns. I think it's certainly possible to just really focus in on stock return predictability and variables there. We were more interested in general economic news and the sentiment regarding the economy and overall GDP growth. We found that more interesting than stock return predictability. But I don't see any reason why you couldn't use it specifically for that subtopic.
Thank you.
Thank you very much. We have another question from Edward Offenbacher.
Sorry about background noise. I'm in a school library. Thanks for a thought-provoking paper. And here's a crazy possible idea for the downward trend of the sentiment. The secular rate of change of technology and structural uncertainty, just things people can't deal with changings. It's too much change going on all the time, which didn't take place, possibly. In earlier periods. Anyway, this explains the very low frequency movement.
Yep.
And
So if your statement is, so the fast pace of change induces a general form of anxiety that leads to negativity.
Yeah, right.
Reporting.
That's the idea.
I'm fully sympathetic to that. There are a whole bunch of different things that are interacting with each other and happening at the same time, for sure.
Right.
So although one thing that I do find interesting, and it's something for us economists to think about, right, is that we have this increased rate of change, and yet for a long time we've been writing, maybe now the AI is going to fix that, but we've been on this secular downward trend in terms of economic growth, right? We've been calling it secular stagnation. So as we've been secularly stagnating, the rate of change has increased. Maybe that's endogenous. Maybe the rate of change that we need to maintain the same levels of growth is getting increasingly harder, and therefore the two effects are related to each other. But it is sort of interesting, right?
It's premium in growth. But the late Robert Solow said the statistics weren't reflecting, the data weren't reflecting the actual rate of growth, but said that a long time ago.
Yes, and you
computers appear everywhere except in the statistics. It's Solow.
Yeah. Yes, no, but you buy that?
I don't know. I'm retired.
No, that's fine. That's fine.
Maybe, I don't know. Possibly.
Excellent. Thank you very much, Akiva, for your question.
Okay.
I will just mute you because there is some noise. I have a lot of questions. As I told you, I will send you the questions that were also raised during the reading group. So I have, let's say, 3 questions. So your paper and also the presentation do not deal with any kind of identification and any kind of endogeneities. And this is related also to the question of Reg before, because Reg asked you, okay, so look how macro variables could impact the sentiment, how the sentiment could impact the macro variables. And we are in this loop of endogeneities. And I think that, so I don't know if you can provide any, how to address these comments, because you are dealing with quite large frequencies. A lot of things could happen in a month. A lot of things could happen in, I don't know, in a week. Maybe you can do the thing, you know, the Gürkenack exercise, which is related to the fact that, look, we take 15 minutes before, 15 minutes after a news, and then we check what's happened. I don't know. I don't know how to deal with that, but there is a strong issue about related to endogeneity and identification. These, of course, do not affect the beauty of the data set, of the paper, but I think if I am a referee, these were the points I would raise. So how would you deal with that, or do you plan to deal with in future versions?
Well, so we are explicitly just being upfront about that. I mean, the data didn't exist before, nor was its predictive power known, right? And so I think the paper addresses those issues. Using super high frequency identification in principle is nice, but will never work for our historical data. So the only way in which then we would have to move to different news sources, say online activity on certain things, but talking also about the trend, I would be very hesitant to use Twitter or something like that to measure general sentiment. I'm very worried about how negative that will come out, because those sources have their own issues, which is there's this huge sample selection bias of the types of people that choose to interact on those platforms, right? And so that complicates the high frequency identification. For the newspapers, they come out once a day. Maybe now with the online publication of articles, we can maybe use the exact timestamps on the online articles that the mainstream newspapers provide, and use then high frequency identification to say something about this. That might be possible, but I don't think at this point the paper needs to take a stance on this, right? I mean, and that also comes back to the question earlier about how does it relate to the Michigan survey. First, just measuring positivity and negativity in the news and how it's changed over the last 150 years, I think is something we just didn't know before. And certainly finding out that it has incremental predictive power over other variables makes it an interesting way to think about that sentiment might have a bigger influence than we thought, certainly in a predictive sense.
And also over such a large sample.
Yes.
This is the strength of the paper. There is no doubt about that. I was just surprised when I read the paper not to see any exercise that would point or discuss these identification and endogeneity issues. That's my point.
Agreed. But between you and me, I wouldn't even know where to start. Tell me which exogenous shock, either through sentiment or I need an exogenous shock to sentiment that is unrelated, right? That moves sentiment around without simultaneously affecting economic activity, or the other way around. I literally wouldn't, every piece of news that comes out, and I think particularly also when we're going to think about, say, stock returns or something like that, all news affects prices. And
but prices or macroeconomic announcements or data release also affect sentiment. So that's the point of endogeneity. And then I don't know how to address it. It's not my paper. I would be I'm very happy to have such a data, for instance, just to start. But I think this is a kind of questions or discussions we would expect to read. I mean, even saying that would be very great. I mean, I don't know where to start, but something that show you. But yeah, it's up to you. So I have a second
point. Well taken, and we can be even more explicit about it. We just really chose in the paper to be very careful to never even have the slightest suggestion of causation. But maybe we should even write.
There is a lot in the paper. The word impact, effect has an impact. The causality is you are very careful in most of the paper. But in some sentences, we have these causalities, words related, impact.
I see. Okay. And we went over it several times.
An estimation is not a causality channel. So.
No, for sure. We went over it multiple times to make very sure that we wouldn't use any language that could be interpreted that way. But maybe we have to go over it another 2 times to make sure that that's true.
Yeah. So my second question is more related to the forecasting exercise. So you are doing so all is in sample. There is no out of sample forecasting, and if I know it's not a forecasting paper, but some in forecasting, doing in sample is not really forecasting because you have so much information in the sample that you cannot say that you are doing true forecast. You need to restrict the information set, all of that. I do think you can do. It is possible to do kind of out of sample forecasting, and I would suggest to do it to strengthen the point. Look, and this is forecasting something, even out of sample forecasting.
No, that's fine. And then one thing that comforted me was that the parameter estimates in the different subsamples were relatively stable, right? So that's generally a good sign for out of sample forecasting, because the thing that screws up the out of sample forecasting is that the parameters change on you, and that whatever you estimated up until now doesn't hold in the next period, right? So,
but the paper is full of good signs, to be honest.
Full of
good signs. Good things. So, but I'm just wondering with my question how you can detail and more deepen this point, because there is a lot of things, and it's enough because you have such a big data set and nice results and nice sentiment. So it's enough in itself, because this is a contribution, and then maybe we can use this sentiment at such a long period as a control variable in other papers, stuff like that. So it's great in itself. But my question is more in the research perspective and how to be sure that the statements that are done are correct.
Correct. Agreed.
And it's also, maybe I have a small question before the last one, which is very important to us. Don't you have a kind of selection bias? It's also related to the question that why we see this decreasing trend in the sentiment over the last 70 years. Don't you have a kind of selection bias when you construct your own dictionary, in the sense that people also in the past did not wrote articles like they are writing now? They are not using the same terms, they are not using the same negative or positive terms, and maybe you missed some terms that could change.
So
I think my question is twofold. The first thing is there could be a selection bias in how you build the dictionary. Maybe you miss some words, or maybe it contributes to the result. And the second one is, could it explain this decreasing trend?
Yeah, so I did address this a little bit in the seminar already, right? So we looked at different subsamples and sort of the words that were used. And I think one fun thing that you can do is read Adam Smith and read Keynes and look at the words and how we are talking about positive and negative economic news. And you'd be surprised how unbelievably similar, because of course, a lot of the words that we use today come from them, right? They defined how we talk about a lot of the economic language that we use today come from that era. And so if you look at the seed words that we have, there are no words there where you would say, oh, you just use as a seed word a word that somebody in 1850 would never have used, right? And so I'm not too concerned about it. And then of course, once you have these vector representations of the words, that once the seed words are correct, the vector representation, just look at how close the other. So what you would need is that how close a word is to the seed words needs to drift over time or something like that, right? That's what you would need. And I don't think that that's, the other thing, of course, then to think about it is that if you thought that this was an explanation, then you would have to argue that the change in language between 1850 and 1970 was immaterial, but the change in language between 1970 and 2020 was enormous, and that drove the results, which again seems a very unlikely explanation of the trend that we're seeing.
Okay, I don't know. I did not check, but it was just a suggestion.
No,
I think it could be checked. I think the change in behaviors, as you have shown with the correlation with the sentiment index from Michigan, maybe you can do the same with terminology or words used before the 60s and after the 60s. I don't know, but I mean, this is a very big question. When we see this decreasing trend, we try to explain it. And when we see how you build those dictionaries, we feel that there is maybe a selection bias that could be avoided. I don't know how. Again, it's not my paper, but I think a kind of discussion or try to address it could be very, very good addition to your paper. My last.
So one thing, right? So for the general trend, right, the seed word, because they should not be economic seed words. So the seed words are very simple, right? The seed words for the general trend that we use is good and excellent and fortunate. The words like this, and bad and poor and unfortunate, right? So those are common words that it's very difficult to see why that would be any different in any of the decades that we studied. Right?
Yeah, for sure. But maybe in the past they used other words that were negatives and that were not catched by these words. I don't know. Maybe other structures of sentences, maybe a more complex sentence. I don't know. Maybe it's not the explanation.
No, but the algorithm picks that up, right? So the algorithm learns about the context of how the seed words in their vector representation, how distant they are from other words. That's the point, right?
Okay.
Anyway, yeah.
Okay.
So as long as you agree with the seed words and you think that the seed words are not wrong for that part of the sample, I think we're fine.
We are. I'm fine globally. You know, I love this paper.
No, sorry,
that's why I invited you. So it's kind of fine. So my last and most important question for us as a central bank is more about, okay, so we have your paper, we have your results, we accept them, they are identified, they are perfect. And so what could we do with these results in terms of policy implications? How could a central bank or another institution could use your results. And I think it was missing also in the paper how we can. I mean, I understand the exercise of the Taylor rule, and it's very nice. Even if I don't understand why you don't find any relation, I understand why you don't find any relation with inflation, but you find a relation with GDP and the Taylor rule. But the Taylor rule includes inflation, so it's a bit contradicting. But anyway, except the Taylor rule exercise, how would you suggest and how would you love or like to see your results or data set be used for policy implications?
Well, so first, as long as sentiment relates to one of the variables in the Taylor rule, I should see an effect on the Taylor rule. I don't have to have it happen on both, right? So as long as, and the Taylor rule has and the inflation measure and an economic activity piece to it. Secondly, I think the first question is, if I were you, I would run the same exercise and see whether for you find that sentiment influences central bank policy, yes or no, relative to the Taylor rule, and then ask the question, do you want this? Do you want the Taylor rule? Do you want monetary policy to be influenced by the sentiment that's reported by newspapers, yes or no? In addition to the standard Taylor rule that you already use to benchmark your rates against. And then I think the finding out whether this is a desirable effect or whether it is that you're responding to something because you feel like the sentiment is such that you must respond to it, or it affects you subconsciously, or whatever happens with it. I think that is an important question. And maybe it's entirely intentional. Maybe it is the case that
there are two questions in what you said. So the first one is fantastic. To be honest, how the sentiment influence the central bank behaviors, which are not necessarily related to the decision of interest rate, but the broad decisions of the central bank. But the second one is more complex because you assume that you have the correct Taylor rule, which is not the case. We know that the Taylor rule does not replicate the rates, even for the Fed, even for any central banks. So the second question is more tricky. But the first one is just excellent.
Yeah, so and that raises a deeper question, right? And so Taylor himself, and of course I understand that he feels that way. He has used his rule as a normative model and said, look, the Fed deviated from the Taylor rule, and if they hadn't, these good things would have happened, right? And so the question is, if you find that there are deviations, do you take a normative or a positive approach? Do you say, this is what we should have been doing and why have we been deviating from it? And then one answer is, well, sentiment has made you deviate from it. That's one other way of interpreting the results that we have in the paper. And so if you're willing to take the Taylor rule as the normative model, then sentiment steers you away from that normative model, and that should then be something you should evaluate. Although, of course, I think your point comes in very well, which is, the sentiment does predict the GDP growth. So to the extent that the GDP forecasts were mismeasured in the Taylor rule that you were using, maybe the sentiment adjusted GDP growth is the one that you should be using in the Taylor rule to begin with, right? And so that's another, and so then everything starts to nicely fit together. It also complicates the matter, but I do think it's something for you to explore. First, find out where the sentiment for you influences the rule, and then see whether or not the effect on growth could justify it. If it doesn't, then now if you're saying it doesn't explain, it, then the important question does become, then what is the normative model for monetary policy? I understand that you can just say it's, yeah, right? Do you have a normative model?
That's another question. We are too far from your paper, I'm sorry.
Okay.
Okay, so we have a lot of comments in the chat, so I will make you a copy and paste, except if we have some people that want to react now or ask a question before we close. Do we have any attendees? Okay, so we will close this meeting. Yes, Fred, would you like to react?
No, I want to say that's an excellent paper. Thank you so much. That's a very great paper.
Thanks.
Thank you so much.
Thanks for your questions. I really enjoyed them. Thank you.
Thank you.
Thank you very much. Okay, so thank you very much to all, and thank you very much, Jules, for this fantastic seminar and paper, and we hope to have you again in this seminar, and we will keep in touch by email with the comments and also the chat.
I would love that. Thank you. Thanks for having me.
Thank you.
Have a nice day.
Bye.
Bye-bye.
Bye.